Welcome back to another Market Insight call where we sift through the noise to get to the signal to give you some actionable advice. Joining me is Aaron Tuttle. It's just us this week.
Yeah.
Starting off the year, we had a couple guests, Jeremy Schwartz and Dr. Newman. I think those were actually really good videos where we talked more long-term videos that will hold up throughout the rest of the year. Today we'll get in a little bit more short-term than that, typically like we do when it's just us.
We'll be reviewing those just to see how their calls were, right?
It makes a lot of sense. Let's get into it. We do have an outline today, and it starts with we've had market strength. We're going to look at some good news that we've seen in the market, and we'll close with some things that are looking a little concerning. And to start off the year, we did just rebalance. So our signal strategy, about 100 accounts have had a little bit too high of equity drift. So we trimmed that back earlier in the week. Again, if the market keeps rallying, we'll look to do that again. There will be a lot more accounts that have some drift as well. We're also going to talk about hub accounts for clients in distribution. We are setting aside some cash right now into some of this market strength. We'll look at price to earnings ratios, credit spreads. Those are things that are getting a little bit concerning. Market hasn't seen a pullback in 6 months. We'll pull up that chart. It's pretty much straight up. And the hub accounts are going to be 24 months, which is really our baseline. And when we look at expected returns on cash over the next 2 years, somewhere in the low to mid fours. So you can get a nice expected return on those cash. We'll close with some inflation metrics, which are a little bit concerning. So let's just get in maybe the busiest screen I've ever put up here on Insights. I got 4 boxes in red drawn just to show where the market's gone. Start in the top left, S&P 500 at about 3%. I'm looking at the 1 month column. And just wanted to compare that across the globe and other sectors and say, all right, the S&P is up about 3%. We can go down to the red box below that in Europe to show some broadening. Euro Stoxx 600 is up about 3.7 and some more other country-specific indexes that are up even more. Moving to the center of the screen in sectors, if you just turned on the TV, you would think technology was the only thing that's working. There's a lot of other sectors that are starting to perform: materials, communication services, energy, industrials matching technology. So there is a lot of better participation in markets. And to close it out, the All Country World Index is same as S&P, up about 3%. EFA Index right below that. That is developed international, outperforming actually on the 1 month.
They've been saying that for decades now, that international would outperform. 1 month doesn't really make a trend, but it's interesting, certainly starts to grab your attention whenever something that's been unloved for so long is finally starting to show some promise. Once again, just 1 month, though.
Yeah, as our conclusion will be, we think it's a good time to use some of the strength to rebalance, set some cash aside for those that need cash. Sticking with what has been working, we're looking here at the percent of S&P 500 companies trading above their 50-day moving average. Just a way of saying 50-day moving average, the average of 50 days of prices compared to their current price, about 75% of companies are in a short-term uptrend.
Right.
You know, it's a good sign to see broad participation. Of course, once you start getting too high, there's nowhere else for it to go than down. Not there yet, but we do have some strong participation in markets. Moving on, but the other thing we're seeing a lot is comparison to the 1990s with the tech rally that lasted a lot longer than really anyone would have expected. But we did know the way that ended.
Right.
It did end badly in a couple of years where there were 70% drawdowns in tech indices. So I know you're following AI probably even more than I am.
Right, so the reason that we had that bubble in the 90s is because there was real things going on, right? The internet was not a fad, despite some economists that said that it was going to be similar to the fax machine. It was real, and when you have a real movement like this, something that's going to have an impact on the economy, you get manias. But as this chart is showing, we're still a long way off if we're comparing it to the 1990s when the internet was coming up. But I think AI is legitimate, just as the internet was. It is going to make us rethink and do things completely different, and it's adding productivity. We're not necessarily seeing it yet, though we are starting to see margins improve in a lot of the stocks. But I think this is a real aspect that is going to eventually be in a mania as these things happen. And it's going to be a pretty good thing for the overall economy because it's going to increase. Remember, it's gross domestic product. So if you're higher in production, which is what your profit is, then you're going to have an economy that grows. So still a long ways to go relative to history, and I think this is real. So let's stay invested for that, right?
Stay invested in the long term, but obviously looking back to the 90s, the best thing you could have been doing, taking chips off the table throughout the rally. And we did just close out earnings season, so closing out Q4 of 2023 earnings, reported in Q1 of this year. We can see that on the bottom, what I drew in a red box was we closed at 4.1% growth, which beat expectations pretty significantly. Expectations were only for 1.5%. We've been talking about earnings expectations for almost about a year on how low they were.
Right.
Going back last year, we said you basically had 2 throwaway quarters, and then you'd start to see the market's going to start expecting these. We've rallied all throughout this, and we're starting to reach now 2024 expectations at 11%, and at 2025 even higher at 13%, as some of that margin expansion is expected.
Right.
And a lot of that has probably been pulled forward with current prices being where they are. So we no longer have this backdrop of where companies can report okay numbers and start talking about, we are going to improve in the next couple of years. We're going to get to the point where they actually have to perform.
There's a high hurdle that is starting to be set for sure.
Right. And so, again, it goes back to saying now's a great time to rebalance. When we look back historically, we can go to when this strong rally really started back in October of 2022. We've shown the chart multiple times, don't want to go through each box, but really we showed a really healthy rally throughout the last year, which was a strong year for the markets. You'll see strong moves higher and 10%, 7% pullbacks throughout the periods. And we get back to the right-hand side where we did have a correction, which does happen every year. We had it towards the end of last year before we started a rally at the end of October of 2023, which has been about a 26% rally off the low. And there's no red drawn in there. The pullbacks have been so small, there wasn't really a pullback more than a couple percent to even draw. So when we were talking about having some mean reversion or the market's just moving up in a straight line over 6 months, that is what we've seen.
Yeah, absolutely. It's been a while. I wouldn't be surprised to have an air pocket, but it's always very difficult to time because this can continue to go on, and then finally we get that pullback, and where it finally bottoms is higher than we are right now. So though I would say expect some volatility coming, when, I'm not exactly sure, and there's no reason that it can't continue to just muddle through and climb this wall of worry and be much higher before it finally starts to correct. And then if we get to this slide, I think it's my favorite slide because it's so simple. And it's basically looking at what is the long-term trend of equity markets, how much are they going up consistently, and then you just put a couple of bands on it. When is it above that trend and when is it below that trend? And then we use that to try to understand when's a good time to fill those cash hubs. So whenever we were below that green line, we were spending those cash hubs down. I think we got down to 12 months, maybe 9. And since then, we have been building back up. And we're finally back to 24 months, which is our target. We could go higher, and if we continue to see PE expand and the market continue to stay elevated above this line, that could be possible. I think we'll take a couple of quarters off before we raise cash again. But we are able to take advantage of the fact that the market is above its historic trend and use that as a time to fill those cash hubs, do the rebalancing, and really be cognizant of where we are in market valuations, knowing that over the long term it's still going to trend up, but we can be strategic in the way we rebalance and the way that we fill these cash hubs. So it doesn't matter if we have a correction because we don't have to sell anything.
Right. And when we talk about expected returns in the market, if you're pulling forward some of those strong returns, in the long term, if you're expecting 8 to 10%, and we've seen a lot of that move forward, well, expected returns do come down in the short term, but at least on the cash side, they've been holding pretty steady, currently in the 5% range. We'll show a slide about how that is going to come down, but at least in the short term, that yield is still going to be there. We said there were some concerning things, and you actually mentioned price to earnings continuing higher. That's what we're showing on the top chart. It's at 20.6, started the year somewhere around 20. We've said for a while, and Jeremy Schwartz talks about it, when he's discounting cash flows, he's looking at a fair value around 20. And historically, it's going to be somewhere around 18 to 20. we're a little bit elevated. And by no means is this a trading signal. It's actually been studied really closely as a trading signal, and it doesn't work.
Right.
It's just something to show that the market has moved a little bit higher and maybe isn't pricing in risk appropriately. The bottom is fixed income, moving to credit spreads on the triple B spread. So this is the yield you earn additional on top of a risk-free bond at the lowest part of investment grade.
So this is something that we've talked about in the investment committee often, because why continue to have these positions or an overweight? If you can get a less riskier bond paying you similar rates, why not just make those changes? And I think there's prudence there. Can it continue to get closer? Absolutely it can, but really why not just de-risk some of that portfolio and get a similar yield with a lot less volatility and a lot less movement?
What it's showing is it's coming down pretty low, close to 1,
Sure.
which is the historic level that we see that it hits, and generally does start to rise back up, meaning getting riskier before recession, before any economic downturn or uncertainty. I think the market's just getting a little ahead of itself.
Possibly, but it also does tell us that for the market, it does not see a recession on, right? They're saying that buying triple B paper is similar to buying AAA paper. So the market is not pricing in any volatility. It's very comfortable, and we always see that the global sickness always shows up in the fixed income first, right? That's the canary in the coal mine. So not seeing it there, that's actually a bullish indicator, despite all of our negative concerns that we've talked about on the higher PE, et cetera.
We can also look at sentiment, which tends to be contrarian. Meaning we're going to look here on the left-hand side at the individual investor survey, specifically percent of survey participants saying that they're bearish going out the next 6 months. We drew a red line there. It is at a very low level. So contrarian saying there are not a whole lot of bears out there. It tends to mean revert,
Right.
Which means there could be some selling pressure. Similar thing we're seeing out of active investment managers. This is an exposure index, so how fully invested are you? Do you have any cash on the sidelines to be putting to work? Of course, you could go into levered above 100, and they kind of are right now. But we see it's at the high end, meaning they're fully invested.
Right. And this basically means who's going to buy, because everyone's fully invested, and there's not many bears that are sitting on the sideline looking to capture a downturn. So there's not, other than leverage, which is probably not something that's viable, considering interest rates are still elevated relative to where they were historically.
The data on leverage is difficult to get. It comes with a lag, but you can see charts on just margin balances, and they track very closely to the market. Obviously, when people are buying on margin, they're pushing prices higher.
Right.
They start selling, reducing their margin, coming down. Didn't put that in here because the data is a little bit lagged.
Sure.
I think the only data we have are from October of 23. And really, to close out, the last really concern is inflation. Mm-hmm. So last week we got a reading on the CPI, which a lot of people still get this wrong and say that the Fed's looking at CPI. They look at PCE, but you can start to look through CPI and guess where PCE is going to be,
right,
which is the best way to be using CPI, because again, they're going to be quoting PCE. What we're looking at here is the CPI in the dark line, showing that it's at 3.2%. The target of 2 on PCE, which is trailing in at about 2.5 right now, we're above target. And a lot of that is shelter, shown here, where shelter, and we've talked about it a lot, lags in the CPI because they're using an owner's equivalent measure, not a real-time measure. Wisdom Tree likes to look through that and use a real-time measure, and when they show that those adjustments that happen a lot quicker, that inflation's actually closer to 1%. But the problem's going to be it is rising. You pointed that out recently. Even though it's at 1%, we can see the trend is higher, which is obviously going to be problematic to the Fed. And they don't have the ability to look through these numbers as well as we do and say, hey, let's get rid of the bad stuff and then only look at the good stuff.
Right, and I think the Fed's 2% target is from an era that isn't going to be replicated. We don't have fracking coming on. We don't have as nearly a global marketplace with a lot of labor coming on. There's a lot of things that happened over the last couple of decades that are starting to unwind. And just look at the political, geopolitical unrest, especially in the Red Sea. There's just a lot here. I don't think we're going to see 8%, but I think an elevated inflation of 3 to 4% is probably what we're going to see, and I would be surprised just to see that target slowly move. hear your point on the PCE. That's absolutely what they're going to be looking at. And the other thing I think that people are a little snake bitten. If from 2020, your dollar has lost 20% of its purchasing power over a few years. So even 1% or 2%, whenever it's off of a 20% change that you haven't really adjusted to, that's still going to feel like a lot of inflation because what cost you $4 now costs you $5.
Yeah. Now to close it out, I actually was going to close out with kind of a joke indicator with sentiment, but we talked about a lot of real indicators, so I didn't want to muddy that by throwing in a joke. But a lot of people are talking about the Barron's conference, which Christina actually just got back from. The magazine cover was a bull breaking through a screen, and there is an indicator that it's called the magazine cover indicator looking back, where it tends to be a contrarian indicator where you get these bullish magazine covers at the peaks and really, really bearish at lows in markets. But it's been debunked as an indicator. Just there's a lot of magazine covers to use, and of course you're going to be able to cherry pick the ones and ignore the ones that actually didn't fit your narrative.
I think my favorite is when Nicolas Cage is in 5 or more movies in a year. That's a really bad sign for the thing. And so thankfully, and the reason we haven't had a correction is because he's just not in demand right now for movies. So the Nicolas Cage index is also similar to the magazine.
I think it's better we close with cash rates. We talked about it. The yellow line here is forward expectations of cash returns. So right now it matches closely with Fed fund expectations. Right now with it around 5%. This is looking out 2 years where they're expected to come down to somewhere in the high 3s on cash. So we're setting aside 24 months of cash. We're looking out to expected returns over the next 2 years. That's why we said annualized. We'd expect somewhere in the low to mid 4s, with some of that being front loaded because we're going to expect close to 5% on returns within our cash at the beginning part of that period. And as we've been mentioning, the risk probably to rates is actually to the high side. Mm-hmm. So the risk is actually rates staying high for a little bit longer, which the equity market is unlikely to like that. But as we got cash on the sidelines, earning some yield, I think that will make a lot of sense.
I would actually favor that. I know that the economy is kind of muddling through, and if we can continue to muddle through with these higher interest rates, it actually makes companies think more deeply about their investments and are trying to figure out how to bring value in a way that is not the same whenever interest rates are low, where you're just trying to get exposure to anything that goes up, anything that has a market derivative exposure, and kind of make money on the spread. When interest rates are higher, you really have to focus on what brings value. And we're already seeing that within the economy. So I actually would like to see interest rates higher, and it would help keep inflation low. And maybe we could really get to 2%, especially with the amount of productivity that could come out of this AI movement that we're seeing.
Yeah, that's a perfect conclusion. Go ahead and hit that like button and share this video with someone that you think would find it useful. We'll see you next month.